What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is January 31st of 2019. Well, folks, I hope y'all are having a great day wherever you are, and today we've got a few major key topics to discuss for both crypto and traditional markets. For crypto, I not only want to spend some time diving into the recent announcement from Fidelity that their custodial solution should be coming as soon as March for institutional investors in crypto, but along with that, I want to spend a decent amount of time to really dive through the importance of remaining financially sovereign as a project in the crypto space and talk about the recent news that the NIM Foundation might be on the verge of bankruptcy. And in regards to traditional markets, we're going to be talking about the Federal Reserve's decision to not hike rates and what this means for equity markets and markets abroad, even cryptocurrencies. So we've got lots of things to discuss. Let's not push it off any longer and dive right into the update. Before we dive into crypto prices, as you all know, I like to share where I'm going, guys. If I'm going to any conferences, I'm going to let you know. So I want to let you all know that I'm going to NEO DevCon in Seattle in mid-February. It's from the 16th to the 17th. And if you guys can make it out, I'd love to see you there. I'm not only going to be attending the conference, but there's a lot of great speakers. You've got people like Da-Hong Fei, obviously the founder of NEO, and a lot of other people who I admire, like such as Zhao Chen, as well as Tamar Salant, I've actually met in Malta. Really great people. And they got a whole list of different speakers. Some are developers and people from different areas. So it's really awesome to see all these people come together. If you guys would like to make it out, there's a promo code you guys can use for discounted tickets called NEO DataDash. And we'll also be giving away a few tickets for the conference as well. So leave a comment down below if you guys would be excited to go and what are some reasons that you'd want to attend the conference. So leave those comments down below if you guys are interested. Outside of that, I hope to see you all at the conference if you can make it. So in regards to cryptocurrency markets, over the past 24 hours, markets have not moved in any dramatic way. You can obviously see most cryptocurrencies are in the red here following a slight dip in Bitcoin's price. But again, Bitcoin is slowly riding down on that line of support that we've seen. That's a lowering line of price levels. Again, not making any serious moves to the upside or downside, but I think it's playing out towards the fact that we're going to be revisiting the lows here over the coming week or so. So as we go ahead to take a look at coin market cap, we can see here in regards to the market capitalization for the overall market, looks like we're coming down to retest the relative lows at around 111 billion. Again, volatility is so slow right now. There's not much, volatile movements in the markets, but we can see it's a gradual slow grind here where we're starting to get some, again, dramatic sell-offs here back down to eventually where I think it's going to go, which is 100 billion. And that would be really good to see. That's the big even I hope we hold, because that will solidify at a very clear even number market valuations in this case. But I think more and more of that is going to be going to altcoins in the next few days. So keep an eye on that as we start to see, again, lowering levels of Bitcoin dominance here. So long as this trend continues, that's where I'm putting my mind right now, that there's going to start being some risk taking if we start to retest the lows and we hold, which would be really good to see. So, well, I don't know. We'll have to see. XRP was getting some good momentum here, started to tether off here. Excuse me, sorry, other coins were getting some strong traction here around 20%, and it seems like we've had a little bit of resistance, whereas XRP and a few others have started to really pick up the pace. Some of the larger cryptocurrencies, as a matter. So in regards to TA, guys, we're not going to be doing too much today. There hasn't been any serious moves, but again, I'm emphasizing the fact that I think we're going to retest the lows here on Bitcoin, and with Ethereum, Litecoin, XRP, you guys can kind of do the math, probably going to be coming down as well, if not maintaining their Bitcoin dominance. But I think their USD is going to obviously follow with Bitcoin in that case. So not do anything too crazy. I'm waiting for that to happen. I'm waiting to see a break on that line of lowering support that we've seen on the chart that we've discussed in the past previous daily updates. Just trying to save some time so we can go ahead and talk about some of this news, because I know I will be rambling on today. Alrighty, so Fidelity launching a new custodial platform for cryptocurrencies, and this is something that I think has excited a lot of people, because Fidelity has not only been one of the more forward-thinking companies with cryptocurrencies in the traditional space, but along with this, custody is a really big issue for institutional investors. And when you're talking about having, say, $100 or $500, custody is not a really big issue, right? You could store probably that money, unless it's your life savings. You could probably store that on a desktop wallet, a mobile wallet. It's not the end of the world. But when you're talking about managing tens of millions, if not hundreds of millions to billions of dollars of investments, that's an issue that concerns institutional investors, right? They want to know that their funds are stored on a safe platform. And as much as we see, Coinbase and all these companies, they're very respectable in the crypto space, doing great strides to actually provide custodial solutions, it's very common that you're going to find these institutional investors who come from an equity space who have used platforms like Fidelity are going to trust a name like Fidelity to actually manage this. And I don't think that's a really good thing. I think that, getting caught in that stigma of, oh, I've always trusted this platform, I'm going to trust them with my crypto funds, is not the smartest, because Fidelity might not be the best candidate, right? I'm not trying to, I'm just playing devil's advocate. I'm not trying to talk down Fidelity. It's a very respectable company. But in this case, with this coming out in March, we'll have to see if their solution works well. I think it'll work just fine, but you can see that there's an obvious demand here for this. So the platform is not only set to launch in March, where they're going to start offering these solutions to people who want to invest in Bitcoin and Ether. This is really the first two that they're going to be starting out with. But along with that, they're also hoping to have a variety of other cryptocurrencies, and they're starting off by the next 4 to 5 in regards to market cap. So it makes pretty good sense. Usually when you have a decline in, as you go down the list, in this case for market capitalization, you get the next big cryptocurrency from the ones that you're probably already offering. And I like this quote here: "These institutions require a sophisticated level of service and security equal to the experience they're used to when trading stocks and bonds." So again, it's the brand recognition in this case. And that's a big thing that you hear emphasized a lot. I think Jim and I had an ad just the other day where they were talking about how on buses in New York City, the major thing that they're promoting is how their funds are safe and how they go through the proper procedure for security of funds. And that's important with all the hacks that have been happening in crypto. You got to think, isn't that going to turn the heads of a few institutional investors when they see all these news pieces from Cryptopia to I think I can't remember the exchange, CoinCheck in Japan, so many terrible multi-million-dollar hacks, right? They can't have this happening. So again, a lot of these exchanges, they get caught with bad practices, and it's human error, which is a really good piece of news for cryptocurrencies. It means that the technology is there. It's just a matter of us building the proper custodial solutions for human management. So I'm excited to see how FDAS, in this case, Fidelity Digital Asset Services, does. And I'm interested to see if they'll actually gain some institutional traction, which could bring some demand for cryptocurrencies. Very excited about that. So going on here to talk about NEM. The NEM Foundation is on the brink of bankruptcy and plans to lay off and pivot. Now, this is something that kind of threw me back, because NEM as a cryptocurrency has done so well over the past few years. It's one of the major, I think, top 20 cryptocurrencies, and it's one of my favorite protocols. I know a lot of people, if you guys have watched my channel for a long time, you might recall back to when I was like, I don't really know much about NEM. I don't know anyone who's invested in NEM, and I think it was a little bit of, I was a little bit blindsided in that time, to be self-critical, but in this case, the NEM Foundation is one of the core organizations around NEM, which is actually one of the real protocols that's gotten real business adoption, which has a variety of different features where you can instantly start developing smart contracts. You don't need extreme knowledge. You don't need to be a Solidity developer in this case, and it uses a variety of languages that people are already comfortable with, which is quite exciting. So in that sense, I'm not trying to shill them, but if you guys haven't looked into it, really recommend you check it out. They're actually really set on getting real institutional adoption. But the NEM Foundation basically found itself in a position over the past few months where it was basically on the verge of bankruptcy. Now, I think this comes to par with a few different things, and this is something where a variety of projects, and us as investors in a lot of these projects, or people who are partaking in these communities, we need to consider when we're supporting certain projects. And it has to do with a mixture of a few different things. The first thing is that if your foundation is being funded by a specific token or a specific cryptocurrency of some sort, you need to make sure that you can account for the volatility of it. I think a lot of people during the bull market, especially a lot of ICOs, for example, raised a lot of Ether and they didn't cash it out. Right? They didn't cash it out to make sure that they had enough funds, that the original funds that they raised, because they saw Ether continuously going up. And a lot of these cryptocurrencies that have these kind of foundations as well do the same thing. And in this case, you can end up having sometimes a lot more than you originally had, and then you sometimes get a little bit caught up in the fact of speculation, and then it ends up, oh wait, now we have less than what we originally had. And not to mention, when you had, for example, the problems in the original NEM Foundation, they just replaced the elected, they just put a new president in named Alex in this case, who was replacing the previous one. They had someone who was rambunctious with their spending, wasn't budgeting things properly, and because of that, you can ticket up enough expenses, and originally, whereas you thought you had your reserves that you could pay for it, it turns out that the value of those reserves have gone down. And now you get in a pickle where out of nowhere, you're roughly down 7.5 million that you can't account for. And in this case, they're requesting over 160 million tokens. So I'm a little bit disappointed to see this in NEM. It obviously seems like they're making the right policy shifts in this case. And again, it's not not so much NIM the protocol, it's the NIM foundation, but still would like to see more expansion in that case. And along with that as well, people were talking about how there was a mixture of important steps that they should take. And the big thing I completely resonated with here is that they focused on the fact this was an anonymous developer in the NIM community, basically saying that unless you're in Japan, the community is not there, like the community of developers. And that's kind of true for NIM. It's mostly the people I met are from Japan, Australia, kind of the kind of Southeast Asia portion of the world. So I really want to see NIM continue to expand. I hope they get out of this. Again, one of my favorite kind of underrated underdog protocols that doesn't get a lot of hype or talk. But again, important feature to take into account, guys, is money management. It is so important because these projects or these protocols are almost, in a sense, they're almost like businesses. They need to have a sense of accounting, especially during the early days, while there's a lot of development, while it's all around marketing, and they need to get their name out. So anyways, I've rambled on enough about that, but I think it's an important thing to take into account. And again, I wish all the best to NIM in this case. Alrighty, so let's go ahead and talk about the Fed's whiplash, the complete shakeup in a lot of people's minds where the Fed was looking to raise rate hike in this case, or raise rates, and actually decided not only to keep them stagnant, but stated that they were open to potentially pulling back the sell-off in the balance sheet, the reduction of the balance sheet, quantitative tightening. So over the past few months, Fed Chairman Powell has been talking avidly about how we would be going through a slow, steady rate of increasing rates, the federal funds rate in this case. But along with that, talking about how the balance sheet, or the depletion of the balance sheet, where they'd start selling off treasuries and mortgage-backed securities, a lot of the things that they pulled off the market during quantitative easing, that it was going to continue to run on autopilot. Right? This was the famed quote that he had stated for months, that this is on autopilot. We're not up for debate on this. It's doing its thing. We've decided this for a while. Well, now they're talking about potentially cutting back on that. And not only did the lack of a rate hike bring optimism to equity markets, that's just music to their ears, but now the talk of not having to compete with the sell side weight of U.S. Treasuries and mortgage-backed securities and assets abroad, and if other central banks can follow suit, this is really good news. So let me explain that a little bit better in this case. It's one thing for the U.S. markets to do this, right? It sends a good signal for equity markets because there's a lot of sell side pressure and also matching buy side pressure where money would be flowing into buying these mortgage-backed securities, buying the U.S. Treasuries. Now that capital can potentially go into other markets where there's not sellers, right? So you're not flooding the market with assets like treasuries and mortgage-backed securities. They're taking up capital from the open market that's going to the Fed. Now that money can actually go to equities. It can start to go into other spaces as well. And it's a whole matter of supply and demand in this case. What's being sold, what capital is available. And the signal that this sends, as I mentioned before, is that other central banks have a little bit of leeway, because this is always a competition. The management of monetary policy is a competition for currency valuation. If you go ahead and take a look at Forex markets, guys, you can see the US dollar depleted quite heavily yesterday. It dropped about, I'd say near around 1% yesterday just from this announcement. And that sends major signals of purchasing power across the world, changes in purchasing power between different currency pairs. It dropped to the Canadian dollar, it dropped to the euro, the Great British pound, all the major currencies across the world. It lost purchasing power to, because it gave them, they sent the signal that they're going to have to pull back on the quantitative tightening that they've been doing, and now other currencies can kind of have some leeway in this case. They can go, now they don't look as bad, right? Even though some of them are still going through quantitative easing or just exiting quantitative easing, or still might have lower rates, or rates that haven't moved in a while. That's where the difference comes in here, and now it buys them some time. So the rat race between these central banks is still going on, and it looks like the Fed has lost some of its lead with saying such hawkish statements in this case, or I would say hawkish is more of a more towards their eager to rate hike. So improper use there. I would say more than anything, they're losing a lot of their confidence in this case. So let's go ahead and talk about some of the reasoning for it, and then along with that, we'll also take a look at equities and make sense of it. So this is something I like to look at, the St. Louis Fed Financial Stress Index in this case. This is a custom index made by the Federal Reserve, and it matches in a few different things. They talk about some of them, for example, 7 interest rate series, the 6 yield spreads, and 5 other indicators all meshed together. And you can see here, obviously, during times of recession, the index spikes up. And when we start to exit recession, we usually tend to go towards a lower band, usually below the zero mark on the index. Now, we have been remaining through here ever since back in 2009, and well, except actually outside of May of 2010, as well as September 2011, where we got very, very close to that level. But as you can see, as of recent, really over the past 5 years, outside of 2016, where we started to have some fear really from the market sell-off back in 2015 in the summer, and then also as of recent, we've started to see a retest of those levels. Now, this came at a time where mortgage rates were starting to spike up, home sales, it was obviously becoming clear, were declining in this case in the United States. And now, since, December and stuff, we've seen a drop in regards to the kind of rebound in equity markets. And again, I'm rebounding some of the indicators that we talked about lower in the lower portion of this page. But the big thing is that it's important to understand how this index should be read. And it's that market conditions, normal market conditions, should actually be at zero, right? That's what it states on the index. You can go ahead and check it out yourself, guys. This is one of the major indexes they use to gauge market sentiment, and it should be at zero in normal healthy conditions. But we haven't even reached that. We're still well below that. We're in a comfortable zone where they should be eager to raise rates, according to the index. Now, of course, this isn't the only thing they use, but I think it gauges something here. This isn't the Federal Reserve feeling concerned. I think more than anything that they were definitely noting some of the sharp rises in some of these, the sharp depletion in equity markets, but I think the latter of the two really plays the biggest role. They care that the markets are panicking too much. It's the same exact thing that happened during Janet Yellen, where time and time again markets would whine and complain that assets are selling off and that this is going to cause the next recession. And again, time and time again, they baby into markets, and they not only talk about not raising rates, but they talk about pulling back the thing that they claim for the past 2 or 3 years that they're going to stick to, which is reducing the balance sheet. And it's so pitiful, right? It's so sad that we're at a point where our economy must be so weak that we can't even account for reducing the balance sheet for a few more months, or raising rates to, God forbid, 2.5%, right? So I think this sends signals as to just how weak equity markets are and how fearful they are. But yesterday's news obviously brought some good green price action. And you know what? I bet today, there's already, I think the NASDAQ was up 0.8% last time I checked it. It's pre-market right now, about 30 minutes before the market's going to start trading. I bet the market's going to come up right up here in regards to the NASDAQ, and it's going to test this line of resistance. If you do not get a close above this line of resistance, and in fact you hold here for about 2 or 3 days and roll over, man, that is going to send signals. If you start to roll over there and hit resistance, and then we start to really pick up the sell side action we would expect, as we've seen every single time here, with the Fed announcing that it's willing to reduce its the pullback. It's willing to reduce the sell off in its balance sheet. It's willing to freeze on interest rates and maybe even pull them back. That should send signals of fear to equity markets, because if we are that weak at this point, as the Fed kind of sets the kind of puts their foot in the ground and stops everything in trying to defend markets, that's extremely scary. That's extremely scary in the sense of the actual fundamental value here for equity markets. So again, guys, a very interesting thing to keep in mind here. I'll be fair, did not expect the Fed to be this 180 on its policies. So it'll be interesting to see if we actually can break through this and test back up to market highs again, or if we're going to turn over here. And I can tell you, if we do not get past this line, it is going to be a bloody month in February, which is what I recently have been talking about. I really think we're going to see in February a much bigger sell-off in this case, if we can't get above this level. All right, so anyways, guys, that's it for the video. Thank you all so much for watching. If you guys have anything you'd like to add, please leave it down in the comments down below. I'd like to hear from you all and hear what you all think about all these different topics, from the Fed rate hike to what's going on at NEM as well as Fidelity. Do you think it's going to be a big catalyst for crypto adoption? Lots of things to talk about, guys, but as always, I appreciate you for sticking around, and I'll see you all in the next one. Stay tuned.